Welcome to my channel. I'm the cover call guy. My goal is to create a $120,000 per year passive income using only cover call ETFs. My portfolio currently yields about $70,000 a year and about $6,000 a month. Legal disclaimer before we start. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions on my own and may be incorrect. Trading and investing involve risks, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I am just some random idiot you found online, and I could be completely wrong. With that out the way, today we are going to be myth busting. Do cover call ETF limit your upside too much? Well, I'm going to say no. Not everybody wants to retire at 65 because everyone's going to say, why invest in cover call ETFs? Just go with growth. And that my answer is that one, you're wrong about cover call ETFs limiting your upside too much, and two, I don't want to retire at 65. I'm trying to retire as early as possible in my 30s. All right, let's begin. The myth's origin, the generational one funds like QYLD. When I was doing my research trying to compile and put together this presentation, I found that a lot of people echo chambered pretty much on Reddit and X about especially the growth investors, right? The boggleheads and the fire movement and um, just a lot of Reddit subs in general that are not for income investing or cover call ETFs. And I just find that they always use the same cover call ETFs over and over again as an example, and it just becomes an echo chamber, right? One person says it, it gets a lot of upvote, so everybody sees it and everybody thinks it's because of these cover call ETFs that is not a good investment. And so right there it's already a flawed premise, right? The myth is based on passive funds like QILD and the BMX index, right? Their strategy writes calls on 100% of the portfolio, sells at the money, use a rigid passive monthly schedule, right? This structurally sells all the upside, leading to chronic NAV erosion and a severe bull market lag that created the myth. They think that all cover call ETFs are built like this. They don't go further beyond and actually doing the research and uncovering great cover call ETFs. They think that it's just QLD, since it was released 3 years ago, that all cover call ETFs are like that. So that's false already, and we're already breaking that narrative. Right, busting the myth, the Gen 2 toolkit, right? One overlay percentages instead of 100%. Modern funds use partial overlays, 25 to 75%. This leaves a sleeve of portfolio uncapped to participate in growth. Examples: GPIQ, QYLG. Strike selection instead of at the money, managers sell out of the money options. This creates a buffer for upside appreciation before the cap is ever hit. Examples: SPY, XDTE. And then tenor is just expiry. Instead of monthly, new funds use daily zero date time expiration options. This resets the cap every day, allowing the funds to capture the previous day's gains. Examples: iSpy, XDTE. And then, of course, the management styles, right? Instead of passive, there's active managers. These active managers can tactically choose not to write calls during a rally or only write on specific stocks. Examples: Devil or Jeppy. So again, there's a lot of different cover call ETFs that people can buy for a specific, or not even specific. A lot of these new cover call ETFs are now multi-purpose. And you see, when you do your research and you hear, if you are new and you are trying to think about getting into cover call ETFs for the income, I hope you come across my video. I hope you watching my video to its fullest, so you can understand that a lot of these people, they're scared, they're nervous. You know, they're afraid of cover call ETFs because they're afraid of missing out on the growth, and or they only think that you have to invest 20, 30, 40 years, if you can even have a job within the next 10 years. Who knows? Because it's the safe traditional path. That's why they rely on a few selective cover call ETFs, or they use the super ultra high yield ETFs that have a lot of NAV erosion, and they use those to kind of, you know, make a picture of every single cover call ETFs, labeling the same. So a lot of it is BS, a lot of it is noise, and I hope you guys are actually listening to what I'm saying and doing your own research, because every single cover call ETFs, right? Every fund has a different strategy. They execute differently. Every fund hold different types of the market, right? SP 500, NASDAQ, Russell 1000, Russell 2000. It's all different, right? And then the critical insight, right? The tax treatment as performance multiplier. Ordinary income coming from JEPQ or in JEPI, right? They have ordinary income and they are taxed at the highest, right? This is inefficient for a taxable account. And then we have section 1256, SPY, GPIQ, XDTE, right? They use the 60-40 long-term and short-term, right? This is the lower effective tax rate by about 10% for top brackets. So not all cover call ETFs are the same. Right, this is just another myth that you can actually multiply and make more gains than choosing a cover call ETF for a specific job. Of course, I'm going to always use the 2022 bear market. Generation 1 funds XYLD offered a buffer, but Gen 2 active funds, JEPI and Divel provided elite capital preservation. The high cash flow is ideal for reinvesting, right? Buying the dip during downturns. So you get a good buffer, and you still get high cash flow. And on top of that, if you're working, that's active income, right? You're using money from the payout and your active income to now buy the dip. And then when it recovers, you are absolutely going to destroy this whole myth of capped upside. And then we use the 2024 bull market upside capture, right? The NASDAQ QQQ versus JEPQ, right? So you can see here in a steady 2024 bull market, JEPQ's active out of the money strategy captured 97% of the NASDAQ 100's upside, lagging by only 0.69% while providing a high monthly yield. It's insane to me. If that's the argument, then that's just insanity to me. I mean, how is this even an argument that this isn't a capped upside? I don't know. Let me know. I think that's stupid. I mean, you can live off depending on your investment size, your portfolio size. You can literally live off and capture the upside. I mean, that's a win-win for me. I don't know. Maybe some people want 100%. The generational 1 lag, why QYLD fails the growth test? Well, it's because of a rigid strategy, right? And it's in a 2023 the rip your face off rally, right? Pretty much that rally, the 100% at the money monthly strategy devastated the growth, right? NASDAQ QQQ went up almost 55% versus QYLD of 22%. QYLD forfeited over 32% of the market's return in a single year. Right, this is the limited upside myth in action. Improves generational Gen 1 funds are unsustainable for long-term NAV growth. And I don't think anybody, including a cover call ETF investor like myself, is going to even argue for QYLD. Yes, it is a cover call. It does make us look bad, the cover call ETF investors. But don't label QYLD as if every cover call ETF / income investor invest in it just because it's a cover call. There are plenty. There's at least 20-25 more cover call ETFs that are amazing. The solution, partial overlay, right? GPIQ and 50-50 QYLG. By leaving a sleeve uncapped, modern funds capture most of the upside. GPIQ's active partial overlay lagged only by 2.72% in 2024. QYOD's 50% overlay also captured a massive upside versus QYOD. So I'm just saying these are some of the two great stocks. I mean, it's just echo chamber, you know. And I hope people who are trying to retire before 40, they don't make the mistake of just listening to people on Reddit, because as much as there are smart people on Reddit, on the YouTube comments, on X, or whatever platform you guys use, you know, there's also a lot of dumb people, a lot of stupid people. So it's very important that you dig deeper. And I'm talking from experience, because I was the one that fell for these echo chambers and pretty much just listened to, oh man, cover call doesn't work, just stick with growth. And when I realized when growth, you essentially need millions of dollars before you can sell it all and rotate it. It to me, it makes no sense. If you have depending on your life situation, if you have high quality cover call ETFs with $500,000, if you're single, $500,000, you can essentially retire if you go to like Southeast Asia, some parts of Europe, South America. Now, if you're a couple, right, and you're relying on this one income of yours, maybe 750,000. And if you got one kid, if you're a couple with one kid, a family of 3, I would say 900 to $1 million. It's a huge difference. With growth stocks, I mean, you're going to be needing like $2.5 million. How realistic is that for 90% of the people? With $500,000, that's realistic for 90% of the people. With 750, it's still realistic for 90% of the people. And at $1 million, all right, maybe like at least 50. That's still more than the growth to do before, you know, you're 65, right? If you're trying to hit like $1 million before 40, right? It's very possible. It's just the amount of compounding you do and the amount you invest monthly or annually. That's really just up to you. It's just another solution here. I spy, right? By resetting cap every day. This fund participate in the entire bull run, missing only sharp intradays, which is the daily days. Pretty much just lagged only about 3.52%. So you get paid and you only lag behind like 3.52%. That's good. That's excellent. That's amazing. If the argument is that, yeah, you're not matching the fold, then I mean that's stupid. Because the SP 500 is not paying you anyway. I mean, you can live off I Spy depending on the amount. I can't say the same for SP 500. I mean, what are you owning that is paying you that much too? Or how much do you have to sell versus if you had the same amount in I Spy? I don't know. The argument made by a lot of these like pure growth, it just doesn't make sense to me. Some people actually would love to work to 60, 65, 70. So I mean, that argument I can't make, because I'm not for that. I am not working past 40. I'm done at 40. And then we have tiers of quality. I just put tier 1, tier 2, tier 3, tier 4, tier 5, tier 6. Tier 1 is your core, your growth and income, JAPQ, Devil, GPIQ or some. Your tier 2, your tax advantages, SPY-I, QQQI. Tier 3 is your growth bias hybrids, QYLG, XYLG. Tier 4 is hyper income, XDTE, QDTE, I Spy. And then tier 5 is your diversifiers, right? Your internationals. And then tier 6 is the legacy / special speculations. These tiers are not really like in terms of like quality wise. It's just more, when I say quality, it's really just what you are trying to achieve. Because SPY-I, QQI, I can put that onto tier 1, but tier 1 is just core growth and income, versus tier 2 is just really focused on tax advantages. So you know, tier 5 diversifiers. Those could be, those are two great ETFs also. I'm not listing them by just how great they are. I'm more listing them by what the cover call ETF specifying. And then it's just the list of 10 ETFs year to date performance leaderboard. As you can see, you know, it is doing very, very well. I don't see how anybody can have an issue with this year to date total return. Plus being able to actually use the income being paid every month. I don't know. That argument just doesn't make any sense to me. It's like, why would you miss out on so much growth? Yeah, but I'm actually using the income to live. I'm actually enjoying my life right now. Paying my bills. Living off the income. I don't know. For some people, it's not enough. They want more. And then my core tier 1 funds, NAV growth, right? These are just some examples. My JEPQ, Divo, JEPI, GPIQ. I put in quotes tier 1. It's just depending on what you want. Some people are okay with tax ordinary income. I don't know. They're okay with it just because they might like the ELNs and the way JEPQ and JEPI they do pretty well in bear markets. They've been proven to do well. So a lot of people like JEPI, JEPQ. I like them too. I don't really know if I would have them back in my portfolio. I did own both at one time. I just switched over to be a little bit more tax efficient, and yeah, I might get back into it. I don't know. I do love JEPI and JEPQ though. And then we have Divo. Again, for those who are new to my channel, I had about $200,000 in Divo, and I just switched it over to QDivo from the Amplified. Love Divo. I will probably in the future probably make it my core holding again, just because of how safe it is. It is a more traditional ETF than a cover call ETF. They're a traditional ETF that uses cover call as extra sprinkles for more income. And then GPIQ is one of my cores right now. GPIQ and GPIX. And then my tier 2 is just tax advantage, right? If you want tax advantage, SPY-I, QQI, IWMI, amazing ETFs from NEOS. The whole strategy, the whole perspective, the whole management team has been excellent executing their strategy on point. And then this is just a question you guys should always be asking yourself, right? This is how you make yourself a better investor. This is what I'd ask myself when I first started to learn to invest, right? What is my primary goal, right? Where's the money? Like how much money can I keep? How much of the money can I retain? What is my market outlook, right? In a strong bull market, where should I have the money? Which stock should I buy? In a sideways market, which ETF would hold out the best, right? In a bear market, which ETF would do the worst, right? You kind of ask yourself these questions, and then you kind of understand which ETF fits your portfolio and your risk tolerance, and where you are trying to be in life. Because if you're okay with being an active trader and looking at your portfolio all day, then you might not care for too much of the volatility, right? You're okay with that. You're okay with the shoot up bull market and going down, and it doesn't really affect you. While for me, I like it steady, I like it stable. I want my ETF to just be choppy in a way, right? And just jump up, jump down, jump up, jump down. I like that. For me, that means the ETF is just doing good. I don't need to watch it. It's very passive. I want to buy and forget, buy and hold, set and forget. Solving the 50-year retirement challenges. This is probably going to be the hardest for us cover call ETF investors, the income investors, right? Especially if you're in your early 30s or even younger. Like I'm in my early 30s, right? And then the challenge is the inflation risk, right? How do you grow purchasing power for 50 plus years if your upside is quote unquote capped? The solution, I'm gonna use NAV accelerators. I think I probably spelled that wrong. Probably should have spell checked that. But it's going to be Gen 2 funds and going to be Gen 1 funds. Right? Funds like JEPQ, GPIQ, and DIVL are designed for total return and capital growth. Their NAV growth is the engine that beats long-term inflation. All right, and then challenge 2 is the sequence risk, right? What if the market crashes right after I retire, right? I want to retire before I'm 40. So when I hit 40, what happens if the market just takes a dump, right? My solution, this is going to be my key advantage, right? Elite downside protection, like JEPI or the hedges fund, minimizes the crash. High monthly cash flow allowed me to live off the distribution without ever selling the principal, avoiding danger zone entirely. So I will probably look more into like Devo and the JEPQ and JEPI, or the hedges or the hedge funds, the hedge ETFs from NEOs, to really kind of have that extra counterweight, right? I'm built for the sideways and bull market, but I need to start building my portfolio for the downturns also. Right, and then of course the alternative portfolio for the nervous investors, right? The 40-40-20 plan. For those who are kind of scared and don't want to go all in and on one side, or they have just enough for the downturns, right? You can do 40% core growth, right? SPY, QQQ, right? Your growth stocks, and then 40% core income, and then 20% strategic diversifiers, right? This is for the nervous investors that are constantly worried. Oh my God, maybe I should have bought some growth. Maybe I should do growth income and then a little bit of the international or bonds. You can do this concentration 40-40-20. It's very, very stable. It's been proven to work. And then my verdict, right? The myth is busted. It's BS. It's a lot of noise. A lot of echo chamber. They always use like a Gen 1 fund like QILD, or any fund that like first came out 3-4 years ago, and it's just been getting beaten and has never recovered. They always use those as an example. From what at least my research have shown, they can't really make an argument for like other great Gen 2, Gen 3 ETFs, right? It's always like, look at this NAV erosion, blah, 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 blah. And it's always, a legacy fund. And then the FIRE plan, right? 100% cover call ETF portfolio is a viable path for a 50+ year retirement if it's built with modern NAV accelerating fund. A resilient portfolio blends high income with growth focused and tactical cover call strategies to thrive in all markets. And I am very, very, very close to leaning towards something like this. I'm blending my high income with some growth focused stocks and some tactical cover call ETFs. So I'm gearing my portfolio to kind of have all three, so I can go on a defensive and offensive. My portfolio will probably be completed with another $300,000 invested. I am trying to reach that within the next 5 years. That's my game plan. And of course, my verdict, right? The limited upside myth is true for G1 funds, but false for modern active G2 funds. And of course, the G1 funds I would consider like the super tax advantage, like NEOs. Modern active and tax-aware funds have verifiability busted the myth, right? Proving they are powerful tools for a total return FIRE portfolio. A lot of people echo chamber, and then it just repeats and repeats and repeats. So when people go on Google and they do the research, oh, does cover call cap upside, and they're gonna always get that first few pages, and they don't go beyond that. That's what happened to me until I did my research and be like, how many cover call ETFs are there? A little over 400. So why are people using only these, 5, 10 examples? Show me at least, out of 400, show me at least 50 that are bad. Then if it's good percentage, if it's 20-25% of cover call ETFs that are bad, and the rest are so-so, and then there's really not much, then I would understand But if you're just using a small section of like the old cover call ETFs, then you know it's BS. You're just pushing your narrative. Thank you. Like, comment, subscribe. I appreciate it. I appreciate you guys liking the video, leaving a comment. I always enjoy if you guys agree or disagree. You know, start a conversation. I always try to reply to everybody as the best I can, because I learned something new, right? Perhaps you have the exact same thoughts as me, and you came across the same exact research and had the same feeling and pretty much the same questions I did. You know, you started questioning like why is it only these specific cover call ETFs people talk about, like, you know. So if you made it out of the echo chamber, congrats, welcome to the channel. Thanks for watching, stay tuned, catch you guys on the next.